Rohr here with an early global view on Thursday, August 20th, 2015. It's currently 6:45 a.m. U.S. Central Time, and we have to note the data is a bit more mixed, but the overall background is still quite negative on commodities, oil, and slipping overall growth. Now, to sum up, that tail risk is back in the form of some mainstream weakness, a theme that we started focusing on heavily once again back at the beginning of May. We have a fresh major commentary, tail risk now mainstream, with a question mark, but a lot of factors are turning up weaker than expected. And it's quite important for anyone who has not already seen that to take a look at Rohr-Blog.com to get up to speed on how factors are conspiring against equities and going to likely boost the govies. And it's going to be a light day on Friday. So, what does all this mean to the markets? To begin with, the S&P 500 future hourly on the left and 30-minute on the right for our short-term view. As usual, the S&P 500 is down $15 at 2058. So right back into the 2060 to 56 important support zone. Even though it traded below it temporarily last Wednesday, we'll see when we get over to the intermediate term charts how that has been the key area this side of the bigger lower supports down into the 2040 to 36 range. But the fact the market's under that kind of pressure this morning is not surprising on what were still accommodative Fed minutes. And that was the interesting part of the swings yesterday, because as the Fed minutes were going to be released and ultimately were released into 1 o'clock, you can see how this market had a bit of a bear squeeze, pushed all the way back up near steady money from Tuesday, up around 2094, but then came right back down in a fairly volatile trade late in the day. And after leaving a down break going back to the morning from approximately the 2073 area, settled in there and couldn't get much worse yesterday. However, back below it, that is reinstated, along with the failure below the 2070 area on the Fibonacci level. And therefore, 2060 to 56 becomes very important once again. And if the market should recover, 2075 to 78 has been the key higher over-under sort of congestion, as we saw once again as it held around that area on pullbacks going back to Thursday and Friday and even Monday early when the market was under pressure initially. Much above that, you're looking back into the 2090 to 88 range, and that basically sums up the support and resistance. The one other factor, though, that was very interesting was that on this couple of time period surge it had into and after, and even closing strong for that hour into basically 1:30, a half hour after the minutes were released, and they sounded pretty accommodative, but then couldn't help overall. The hourly MACD that had dropped below the lower runaway band on the morning weakness was never back above that lower runaway band, and that's why we like to keep a close eye on these. And we presume this market, opening weaker this morning, can feed on itself a bit. The big question will be, can it crack back below 2056 to possibly get below last week's low that it ratcheted up from in the 2048 area and get all the way down to 2040 to 36. And that pretty much does it for the short-term view of the S&P 500.